Hi everybody, and welcome to this special edition of Fang Friday. This is Ross Healy, Chairman of Strategic Analysis Corporation and a Senior Portfolio Manager at McNichol & Associates Asset Management. First, I want to welcome all the new viewers that are watching today that saw me on BNN this week and decided to subscribe to our YouTube channel. We are now less than 10 subscribers away from reaching 1,000. Very occasionally, a stock comes up that is of such general and wide interest that I would like to show our unique SVA methodology to a wider audience. The Fang Friday venue is our open window to the public, and I'm going to use it to show how we analyze the shares of Enbridge, a huge pipeline and utility company with a 6.7% yield and a lot of promise. Maybe. I hope that you will enjoy today's discussion and analysis, and of course, you're entirely welcome to tune in every week from now on. But first and foremost, for our regular Fang Friday viewers, my first dance is with the gal who brung me, so I'm going to start with a regular weekly look at the 7 Fangs. But before we take a close look at them, and then Enbridge, as always, I do like to say thanks to everyone who likes this video and all our subscribers. I'm going to start with what I call our Phantom Fang portfolio, which had 4 stocks in it. And the first one was Alphabet, a company which I have been very, very bullish on. But the operative word is has been very bullish, because the stock has reached my most extreme target that I could possibly have seen its bubble price at 7.4 times book value. Maybe it can go higher, but as I said before, reaching its bubble price, I would take my profits in the stock. The second stock in the Phantom Fang portfolio has been Facebook, which has been really a nice gainer ever since it bounced off its mid-super growth price. That's 5.5 times book value. But it too has reached back to its bubble price, again 7.4 times book, and this now for the 3rd time in the past 4 years. I don't see anything more for the stock, and again, I would be taking my profits at the bubble price. The third stock in the Phantom Fang portfolio is Microsoft, and it just continues to soldier on, as I describe it, sort of an inch at a time. Perhaps it can get up to its HB3, which would be 16 times book value, and it could well be, of course, if the market reaches our target. The last stock in the Phantom Fang portfolio is now Amazon, and Amazon has not been in that Phantom portfolio actually up until really last week. And the reason that it is now is because look what's happened. The stock has fallen to its HB2 price. That's 12 times book value, and that has been a bottom for the stock for the past 10 years. So I expected a rebound, and so far we've been getting one. Now, stocks that are not in the Phantom Fang portfolio. The first one is Apple, which went out when it actually hit its HB6 price, 33 times book value, and has been fundamentally going sideways ever since. Now, the issue, however, with Apple is that swing up in the HB6, is that real, or has the company continued to be buying back stock, which caused, it's caused the HB6 price to continuously fall. If that has been the case, then the stock is very, very close to actually breaking out over its real HB6. It's going to be very interesting to see what happens. In the meantime, of course, we have a nice technical platform here. Maybe we're going to get that to break out sooner than later. Netflix, well, I have not cared for Netflix for a long while, and look at what's happened over the past year. Fundamentally, nothing, although it's been sort of slowly getting cheaper and cheaper in price to book terms. Okay, the competitive pressures, I think, are really weighing on this company. And finally, NVIDIA, which is my personal bête noire, way back in May, I was hoping that the stock was going to fall to its HB3, which is 12 times its book value. Didn't happen, and it did an abrupt turn, broke out over its HB4 at 16, had a run, didn't quite get to its target, almost pulled back here, but not quite, rallied again, almost pulled back again, and rallied again. You know, sometimes you just can't win, and NVIDIA is one of those stocks, I think. So in summary, I started with our Phantom Fang portfolio, and it had 4 stocks in it, but one, Alphabet, on which I have been extremely bullish, reached my wildest target expectation, its bubble price, 7.4 times book, and I would sell. But, as you can see, it might well break out here. And if it does, I would just as quickly rebuy the shares, as the next higher level, the HB1 or 10 times book, is 28% higher. That would make a very nice trade. The second stock is Facebook, which still has a little way to go, although I still doubt that it will break out over its bubble price. Microsoft just soldiers on and upwards, an inch at a time. And fourth, of course, I identified Amazon as having reached a 10-year low, and it's fill or kill time for the stock. I expected a bounce here, and we're seeing one. However, if the stock fails to hold that level, I wouldn't hold it for more than a second. Looking at the stocks that are not in the Phantom portfolio, Apple hit its HB6 and has not progressed any further so far. We can only guess where the real breakpoints are located at this juncture, but if the company has continued to buy back stock, then it may be close to breaking out. Last year, I made a forecast that a $4 trillion market cap was theoretically possible for the company if it kept on buying back stock. And that may not be nearly as madcap as it sounded when I made it, as the stock is nearly 25% of the way to that absurd mark, with more left to come in the market. Sixth, Netflix, a stock which I'm concerned about because of competitive pressure, has done nothing, and I'm happy to leave it where it is. And finally, NVIDIA slipped back to its HB4 price, 20 times book, where I'd hoped for a trade, didn't get it. You know, even an SVA, we just can't win them all. Anyway, my takeaways for this week. As far as the overall market is concerned, our upside target, the LSG price for the S&P 500, or 4.5 times book, remains intact. We are still bullish and plan to stay fully invested, as the short-term downside risks are comfortably below the upside potential. Our parachute is still safely tucked away. And second, of course, will Alphabet actually break out here? I would not bet against it happening. Watch for what could be a very nice trading opportunity. Now, for all of you patient BNN viewers, well, I hope that you've enjoyed the Fang analysis, and by the way, might even consider buying some Alphabet for a trade if it breaks out here. It's your turn to be front and center, and our focus is, of course, Enbridge. First, I need to outline 4 things before I get started. Those breakpoint values that you see in each chart are price to book ratios. That is, their fundamental balance sheet values. Second, they flow from the mathematics that underlies SVA. They are not statistical values. Third, those values hold for all stocks, in all jurisdictions, in all accounting systems, at all times that we have ever seen, and we've seen a lot. And fourth, the slope of those lines tells us what the rate of growth is for the underlying balance sheet. The precise details, by the way, of all of this is laid out in my book manuscript, Inside the Market, which we provide to our clients. Okay, let's now turn to Enbridge, and let's go and take a look at our first slide. Looking at Enbridge, okay, we can see a sort of a Dr. Jekyll and Mr. Hyde sort of graphic. The first slide here shows the steady growth phase of the company ending in 2016. That's the Dr. Jekyll phase. Okay. The second slide, we can see what happened when the company management decided to change the dynamics of growth and go for acquisition. This is the Mr. Hyde phase, and it's still in play. And of course, the third slide, I've put it all together to show you the entire picture. Now, let's go back to the first slide, the Dr. Jekyll phase. You will note that there is a dashed line running through the center of that chart. That is the fair market value of the company, and it's based on consensus analyst earnings estimates looking 1 year out. You can see that the market price of Enbridge tended to hover around this value during the entire period. The dark red line is what we call the growth price, or 2 times book value, and the heavy yellow line is what we call the super growth price, or 3.5 times book value. The other values I'll show you in a moment. Now you can see that after the bear market of 2007, 8-9, the shares decided actually to go higher than their fair market value, the normal relationship, probably, by the way, due to falling interest rates, and it actually reached up as high as 4.5 times its book value. That provided management with some very cheap stock to pursue new growth initiatives, and they did so. Before we go on, however, I want to show you the relationship between the return on equity of the company plotted against its valuation in price-to-book terms. Okay, so now the return on equity, that's the dotted line, and the solid line is the price-to-book ratio, and there is a beautiful correlation between the movements in both. It's a very pretty chart. As you are going to see, this information is very important for what's going on now. Now, turning to the next phase, we see what happened when management expanded its business by using its cheap equity to buy into a U.S. utility company, Spectra Energy. First, of course, when you issue very expensive equity, or actually from a point of view of the company, it's very cheap equity to use to purchase other companies, you drastically increase the average price to book ratio of the company. And secondly, axiomatically, you also will reduce the average the average ROE of the combined company, and you can see, of course, that that is exactly what happened. Third, as what actually happened, if you maintain a very high dividend, expecting that you will wring some synergies out of the combined entity, you'd better be right. And so far, management has been wrong, and the book value of the combined company has been slipping lower and lower and lower at about a -4% annual rate ever since, which you can see from the slope of the lines. Now we are reaching the denouement. Earnings have been pretty flat, although there is an upwards tilt to the fair market value and the ROE, because of course the average book value has kept on slipping, as I will show you in this chart right here. So here is the ROE, which is rising slowly because of the falling price to book ratio. Now, the stock did make a run and reached its fair market value, its typical peak in early 2020, but of course set back in the COVID pandemic. Since that time, now it's been moving back up towards its fair market value, and was trying again, of course, or was until Michigan determined to shut down Line 5. Now, from its own historical relationship, the stock could reach as high as its fair market value, remember, which we'd seen before, which is currently $61, all things being equal. However, there is no evidence so far that there are significant synergies to be gained from this merger acquisition, and that applies into next year as well, because of course our forecasts are 1 year in advance. However, if, and this is a huge if, based on the evidence that can be clearly seen in the SVA chart, if the company could get its ROE back to where it was in the 2001-2009 period, then the upside potential could be as high here as the mid-growth price, 2.5 times book value, or $70, and even more if they can do better than that. Now, I hope that you can clearly see and understand why I was not more bullish on Enbridge on Wednesday. Yes, there is upside potential to $61, or plus 24%, if nothing particularly bad happens. The skunk in the woodpile, however, is the state of Michigan versus Line 5, which is why the market is so uneasy. You see, it's kind of rolling over a little bit right there. If a rebuild is necessary, it could hurt earnings, reduce the already sort of indifferent ROE, and kill any upside potential for the shares in the shorter run. Now, the bottom line. What would I do with the Enbridge stock right now? If I owned it, I would probably have to hold. A 6.7% yield is too fat to pass up. And maybe good things will happen, although there are no guarantees. If I did not own it, personally, I would not be tempted to buy, because the stock is in a no man's land with equal percentage upside and downside risk potential. 61 on the upside, or about 23% from here, and downside risk to $34 at worst, and perhaps 41.96 or 41 at best, or about -17 to -31%. I hope that this analysis and approach that we use, structural valuation analysis, has opened your eyes to what is a radically different but very fundamentally based way of looking at common stocks. If you would like to learn more and see if this will help your understanding of the stock market and your portfolio, then send us an email at info@strategicanalysis.ca to learn more. Anyway, for now, this has been Ross Healy, Chairman of Strategic Analysis Corporation and a Senior Portfolio Manager at McNichol & Associates, reminding you that nothing, including investing, is difficult if you have the right tools. I'll see you next week.